G'day tankers, welcome back to episode double digits number 10 of Money in the Tank, your go-to personal finance podcast. My name's Joel Seach, Principal Financial Advisor.
And I am Chris Arnold, tax professional.
And this week on Money in the Tank episode 10, we're going to be talking about all things money. We're talking about the economy and the market, where the economy sits and how it works and coincides with the share market and property market. We're also going to be doing a great couple of Q&As, so keep our Q&As coming in from all our listeners. It's really good to have, and it helps us with what people want to hear about, what the people want to hear about. We've got an awesome 50-50, so two for the price of one today. Hang around for that. We chat about our listeners, great Rifkin's rules, and also thanks to our producer Matt for helping us out with some upcoming guests that we've got. So stay tuned for some guests upcoming. We're going to have some really good subject matter experts in certain areas, so hang out for that.
Yeah, and if you want to get us any of the socials, it's at Money in the Tank on Facebook, Twitter, YouTube, and Instagram. And please like and subscribe to our YouTube, because that helps us build the channel, and we appreciate it. So let's get into it.
Enjoy, crew. Welcome back, all. Welcome back to Money in the Tank, episode double digits.
Yeah, this is the 10th one, mate. Welcome back, everybody, tankers. Well, thanks for sticking with us for 10.
Who would have thought? Who would have thought we would have got to 10?
Oh, I see our name in lights at the end of this journey, mate. I see bloody thousands upon thousands of episodes. This is the best financial news in the country. Money in the Tank.
I feel like it's a mini milestone, double digits. We should get like a sticker or something, like some kind of we've made it to 10 episodes name badge or sticker that we can give each other a sticker at some stage. And we'll catch up next.
All right, let's think about what we want to do for episode 10, what we want to do for episode 50, and what we want to do for episode 100, and then beyond that, I don't know. We can think about it.
Sounds good. But we don't get along the way with our episodes without having great listener feedback and all you guys submitting your Q&As. So we love hearing from you, and we enjoy hearing that you guys are getting a lot out of it and getting some tips along the way, even if it's one or two things each episode, and hopefully easy listening, so you can cruise along wherever you may be in your car or going for a walk with a dog, and you can listen and get a bit of easy to understand information on all things personal finance.
Yeah, we are loving it. So if you want to hit us up at any of the socials, it's at Money in the Tank on Facebook, Instagram, Twitter, and YouTube. And you can drop comments on the YouTube video, or Facebook's probably the easiest way to get to us. And please like and subscribe, because that helps us build the channel.
So without further ado, let's get stuck in today with a few of the areas we need to cover off on. So speaking of our listeners getting in touch with us, Arnie, from one of our international listeners, we both had a message to Money in the Tank from one of our international listeners this week, Samal Mbekwa.
Yeah, a dude from Africa, and he hit us up with something which didn't really make sense, but I wanted to engage with him because I thought, oh, here we go, we've got international listener from Africa, but me being the optimist I am.
And me being not so much a pessimist, but me being cautiously optimistic, I said to Arnie, the first question was, how in top of tank? And Arnie wrote back, say again, mate, we're not bad, how are you? And then I text a screenshot of that to say to Arnie, spam, question mark. And then Arnie, the optimist, said, oh, it could be, someone that's genuinely interested. And I said, okay, let's see how it unfolds. I'm betting the opposite. Samal gets back to us with, I'm good, thanks, and you? And then Arnie says, going well, thank you, sir. Thanks for the support. And in the morning, I woke up from Samal, sir, I need money, please, PLZZ. And I just took a screenshot of that and said to Arnie, I win.
Yeah, he was coming. He was coming at us for some coin, but maybe one day we'll be philanthropists and we can help Samal out. But we're too small at the moment, Samal. So just keep listening, mate. We appreciate the support.
And if you keep listening, you'll be able to make some money, Samal. You'll be able to make your own investments, and you'll be able to understand finances better. But we do have some overseas listeners, which is great to see from, I think, Japan. Arnie got some in the US. So please, feel free to reach out to us, our international listeners, and let us know what you love or don't love about the podcast and what you want to hear more of. And hopefully those international listeners, we've turned them into Melbourne Demons supporters.
Well, people eat your heart out. We're basically Mr. Worldwides now. Yeah, Japan and US and Australia. We're going global.
And there was a Scandinavian country in there too, wasn't there, Arne?
Yeah, I think there was. I'll have to double check which one it was. But yeah.
Yes. So reach out to us, international listeners. We'd love to hear from you, and it's great to see many people far and wide tuning in each week. Next part of the segment, Arnie, is jumping into our favourite or your favourite segment of the week.
Yeah, Rivkin's Rules, man. I love this segment, and I love tying it back.
So let's flick the book, and we will see which page we land on today. Okay, well, this is actually the first chapter, I believe. It's the rules on investment. So this actually may relate to investment for the first time, which is exciting. All right, so the two quotes on this page, because there's just two quotes on a page, and it's got a picture of Rivkin's headquarters in Sydney's Double Bay, Rivkin Group, which is an interesting building. Read every bit of financial material you can lay your hands on. You never know where you might find a useful snippet. And the second one is never spend your profits before you have liquidated the position.
Never spend your profits before you have liquidated the position. Okay, so I don't really need to give you any extra information on that. That's good info from Rivkin.
Couple of tips there from Rivkin. So well done. I think we landed on the actual investment chapter for the first time. So
yeah, that's a handy one, mate. That's a good one from Mr. Rivkin.
Good stuff. Good stuff. Well, let's kick on, Arnie. So what are we touching on today from a news item standpoint?
Yeah, I got a few items in the news that I wanted to just update on. So just another update about GME, because I was sort of postulating last week that if Deep Effing Value, Keith Gill, were to exercise all of the call options that he had available, then he would own a significant chunk of GameStop. And he has done so. And he actually bought another 50,000 shares on top of what he already owned and exercising all those contracts. So as of the 16th of April, 2021, he has told the internet that he's done his final update. There'll be no more updates after this. And he now owns 200,000 shares of GameStop, and the average price he paid per share was $55.18. And the total value at the price on that day was $154.69. So the total value was just shy of $31 million.
So his average buy price was 53, was it, Arnie? And
55.18.
Yeah.
And he's also, I should say, he's also got some cash in the bank from selling previous call options. So he's got about $3.5 million in the bank. So his total gain, it's on paper because the price is going to fluctuate. But as of that update, he had about $34.5 million tied in some way to GameStop. This is USD. And the other interesting news article I wanted to talk about was, with the hype of coin, and I know you're going to talk about that, Jolie, there has been some chatter about crypto exchanges offering tokenized stock, so synthetic stock. And it's very new, so there's not a lot of information about it, but it basically means that they're trying to get on these crypto exchanges a way for the retail investors to be able to buy stock, but they won't own the actual underlying. They will own a synthetic version. The crypto exchange will be a middleman, and the actual underlying owner will be banks. And there's been a few that have said they're going to get into it. And they were putting some questions to the banks saying, well, what does it mean for, voting rights, for dividends? Essentially, the owners of the synthetic stock will be entitled to any capital growth, any dividends. However, any voting rights will be retained by the bank. So they will have control over basically what that company does if they start owning significant chunks or significant blocks of share of the underlying for the synthetic reasons. So bit of an interesting development, tokenization of stocks.
There you go. Well, I guess it's a moving landscape. The the coins and the synthetics and the all the electric currencies. It's quite an amazing sort of moving thing. Each week you're getting new stuff. And look, Arnie and I don't profess to be experts in the area, but given it's in the market and it's in the finance news, we always try to we like to try to recap on these areas. So we try to give you guys some up to date information, and we'll continue to try and do a bit more research in that area. We may even get an expert if we're able to in that area as well. But and the other areas of the news items this week was Dogecoin. So the frenzy around digital tokens was taking its zaniest turn yet. So the price of a token, which was, I believe, originally created as a joke, buckling the crypto trading system at Robinhood Markets. So Robinhood in the news yet again. So Dogecoin, boosted by the likes of Elon Musk and Mark Cuban, rallied by more than 110% Friday, and then it dropped, I believe, by 26% on Saturday. So it's got a market cap or a value of $36 billion, and it's up about 13,000% from a year ago when it traded at $0.002 of a cent. So,
Man, at its highest market cap, which was something close to 50 billion, it had a higher market cap than like Ford, which is crazy.
it's amazing that something created as a joke. So, yeah, it's the demand's been brisk. So it's a rise in all the altcoins, and it's a term for digital tokens that sprung up, as an imitation to Bitcoin. So
I saw a funny meme. I saw a funny meme saying, personal finance fundamentals, like spend less than you earn, have an emergency fund, deploy money in the market to invest. YOLO your life savings on a meme stock, a meme cryptocurrency.
It just shows the crazy world, we're in, the social media world, and how how these things can go crazy off the back of the back of people spruiking something or pushing something or getting people to rally around something. It just builds momentum off it. So it's quite amazing. So. And then Coinbase. So the Coinbase debut happened last week, I believe, in the US, the initial public offering. So
it was direct listing, direct public offering.
Direct public offering. So it's and one of the actual Australian companies, Westpac, the bank actually owns a stake in Coinbase. So they bought in a little while ago to try to help, I guess, push towards their area of buy now, pay later type stuff, I believe. So they sort of liked what Coinbase was about. So it's had a huge float, and I think its revenue initially has dwarfed a lot of the other tech companies that floated back a few years ago. So it's going to be an interesting one to watch, Coinbase, to see where it stands moving forward. And what they feel about it, what investors feel, and then also what the big instos feel about it too. So keep an eye on Coinbase, and that name won't be the last you've heard of, I don't think.
Yeah, I know. Were you saying as well, Jolly, that Kevin Durant has a stake in it?
Yeah, KD, the NBA basketball player, I believe, he sort of likes to, I think, dabble in the Silicon Valley, and given he's a high-profile NBA basketballer, a lot of the Silicon Valley guys, love to sort of, I guess, getting good with all the professional sports players. So having Kevin Durant, buy in or invest in gets, you sort of know Kevin Durant, and he's an investor in your company, and it's sort of a bit of a social player as well. But KD got in. I don't know where he got in, but he's in there. He might have even been early days with that one as a venture capitalist and put some cash in, and it's probably turned out to be quite well for him. So we'll see. It may actually end up dwarfing his NBA earnings, but again, I don't know the value he's put in there.
Yeah, that's interesting. Oh well, that's some good news items. So we may as well jump into the main topic for this week. So the main topic that Jolly and I are going to be talking about is the fact that the stock market is not the economy. And obviously it is a piece of the puzzle when it comes to the economy, but we just wanted to sort of talk about, I guess, maybe not a fallacy, but just the things that actually go into moving the stock market apart from, the broader economy. So maybe do you want me just to start off with one factor which can, influence the stock market, Jolly, and how it differs? Or do you want to... Yeah,
there you go for it, mate. Yeah, fire away.
I mean, the first one which springs to mind is something we've been talking about. It's a running theme, money in the tank, but it's interest rates, right? So in Australia, we've got our Reserve Bank of Australia, or America's got their Federal Reserve. So typically every country's got a central bank, and they set the interest rate on overnight loans in the money market, and this influences other interest rates within the economy. So basically, like the interest the banks can charge and pay, and this in turn will affect the behaviour of borrowers and lenders. So it's typically been a good lever to stimulate the economy. We know that at the moment interest rates are at all-time lows, so it's sort of, I guess you got not much powder left in the keg there. But if I could just read this quote for you, Jolie, which is from the Reserve Bank of Australia. It says, "In determining monetary policy, the bank has a duty to contribute to the stability of the currency, full employment, and the economic prosperity and welfare of the Australian people. To achieve these statutory objectives, the bank has an inflation target and seeks to keep consumer price inflation in the economy to 2 to 3% on average over the medium term. Controlling inflation preserves the value of money and encourages strong and sustainable growth in the economy over the long term." So basically, when interest rates are low, there's going to be more money in the economy, and naturally that will stimulate spending or saving or investing. And that's sort of what we're seeing at the moment is people there's more money in the economy floating around, and we're seeing record levels of investment in the stock market as a result of that. Or that's what people are postulating anyway. So that was the first one I wanted to cover about what can influence the stock market as it relates back to the economy. Do you have one off the top of your head, Jolly, or do you want me to hit you with one and you can have a stab at it?
Yeah, you hit me away, Arndog, and we'll have a go.
Well, one that flows logically from interest rates is like when you run out of powder in the keg is quantitative easing. And I know we've sort of touched on that as well, but do you want to talk us through what it is?
Yeah, so we spoke last week on quantitative easing and quantitative easing, QE, and we've got a Q&A question which actually floats around that as well, so we might tag that on the end of this little segment too. But I guess speaking more broadly around the economy and the stock market, let's say, so Arnie's touched on the RBA and interest rates and whatnot, but let's talk about the economy and the market. So the two are very different. So when we talk about the stock market effectively is predetermining or pre-pricing in and predicting 6 months, 12 months, even 18 months down the track as to what they predict or assume the economy will be doing. So when, the pandemic hit, which is a great real life example of, something crashing, the market was so uncertain and had this snowball effect of selling down because they just didn't know what the future how it was going to shape up. But as more news came about the virus being, starting to be contained, or it was less lethal than first thought, or economies and people and populations and governments were starting to get a handle on how to minimize the spread, and then vaccine news started to come out, and these things are all they weren't done at the time, but they were predicting in the future that these things were going to come into play, which is why the future prediction of the economies will actually, the stock market will lead that. So always be mindful that once something's out here, so let's say the vaccine rolled out last month, for example, that has already been priced into the market a long time ago.
Yeah, potentially. And what Joe was talking about there, we sort of jumped away from quantitative easing, but it's geopolitical, right? And that's another one. So anything that's going to, I guess, affect certainty or uncertainty in the market. So you've got things like war or natural disaster or trade wars or terrorism or diplomacy, or even like, how last year we saw the crazy movement in OPEC oil prices, Jolly? And I think at one point oil was like $- a barrel. Like you could get money.
You had to pay to.
They had to pay to deliver it. Yeah, so people could like take money and take delivery of oil if they had the capacity to do so. So
because no one was using it, it was a crazy time that all these tankers and all these cars and trucks were sidelined and had all these oil barrels building up and had nowhere to store it.
Well, that's right, and these kind of events either create uncertainty in that sense, or as you were talking about, like with the vaccine rollout, that might be a catalyst for certainty. And the stock market reacts always to those events because investors love certainty and they hate uncertainty. And if it's an uncertain market, that's typically where you might see panic selling occur, and then you might see drops in the market, and they can also reverse just as quick. So that kind of ties into another factor, which I wanted to talk about, and you can hit me with anything you want as well, Jolly, which is human emotion, because it kind of plays into, fear, greed, and speculation. And there's a famous quote from Benjamin Graham, who's the author of The Intelligent Investor. And he basically says, I'm probably paraphrasing, I don't know exactly what he says, but he says, in the short run, the market is like a voting machine, and you basically just see which firms are popular or unpopular. But in the long run, the market's more like a weighing machine, and it checks, what is the actual underlying substance of the company, and how much cash flow do they make, and what assets do they have, and how strong is their balance sheet. So it's, I think that one, human emotion. And he also has another famous analogy about Mr. Market and how the market will, be erratic and stuff. But yeah, it's like playing into human emotion. People are always going to be wanting to make money. And I think an extrapolation of this is something that Warren Buffett says, which is be greedy when others are fearful and be fearful when others are greedy. So that's another big factor which can move the market, I think.
Yeah, I completely agree, Arnie. And sometimes it gets lost on the market moving the way it's been moving and up and down, and all these these alternate currencies and digital currencies coming in as well. So that's what we were sort of talking to before, was people getting very almost crazy like in terms of wanting to jump onto something that's running, and that's the emotional thing about markets. And
FOMO.
Fear of missing out, and it can relate, to property as well, what we're going through at the moment. But essentially, what the Intelligent Investor Graham was saying is that short-term lunacy, I guess, or crazy hysteria about buying into something or selling out of something, that will be a short-term thing. But the longer-term play, which sometimes does get lost in the day-to-day trading and the media cycle we live in, with such instantaneous information about something going up 1,000% or dropping 50%, it gets lost sometimes, because it's that medium to longer term play is where the proof will be in the pudding, so to speak, as to what something, what company or property or investment will end up doing over a period of time will largely depend on the core and the roots of what it is and what it does and what business it is, and what property it may be.
Well, it's a beautiful segue into my last one, and I will circle back to quantitative easing, but my last one was fundamentals. So fundamentals in the economy, macro and micro. So basically, macro is, the broader, wide one, and micro is like, I guess, when you're focusing down on a small part of the economy, like let's say a business. So if I just focus on macro for a second, the stock market growth and shrinkage is linked to the economy through these fundamentals. So things like gross domestic product, which we talked about last week, or GDP, or the consumer price index, CPI, or the producer price index, PPI, in America. And I think we've got something similar here. There's macro data, which is it's called non-farm payroll. So it's payrolls that exclude like agricultural or local government and things like that. So, or the unemployment rate is another one. And if you think about it from like a business fundamentals point of view, then you're going to be thinking about things like how much assets do they hold, how much cash flow can they produce into the future. So those fundamentals will affect the growth or shrinkage of an economy.
Yeah, absolutely. And, the economy, I'd love to segue. I've got some notes here on economist predictions. That's a really interesting topic. Economists are very, a very useful thing and good at having an overview of what the economy is doing in a certain point of time, whether it be CPI or the unemployment rate or, some GDP growth. But they tend to be good at putting all figures together, but not all the time are they good at predicting what's going to occur in a certain event. So, stock market predictions or property predictions, economists, that's the thing that I'll always be mindful of, is don't necessarily listen to economists too much, because they're not necessarily going to be experts, subject matter experts, SMEs in certain areas. And case in point, which we mentioned back on the property podcast, was the economists coming out, putting all their numbers together for what they thought the property market would do during the pandemic, which was negative 25 or 30%. Some economists' predictions tended to be, and then those economists very quickly rewrite their predictions or may not be heard from again, and they lay very quiet on their outlandish comment. And there's, 6 months later, they're turning around saying we're thinking it's going to be a plus 15 or plus 20% property market. So,
it's so hard though. Yeah. It's so hard, Jolly, right? Because there's so many variables, as we've just outlined at a very broad sense. Like, think about all the variables we just talked about, and we talked about them at a very broad, high level. And I will just say, quantitative easing, just for to close the loop, it's basically printing money through the central bank or the federal bank, and they increase the money in circulation, and they'll typically buy up bad investments like toxic assets, basically, to try and remove it from the market and leave only quality investments in there, which in turn will leave companies flush with cash. So they now have cash instead of those toxic assets, and then they can, spend that cash and try and grow the economy faster. More growth is the goal of quantitative easing. So, but as you were saying, Jolly, like, economists have a tough job in predicting these things, and essentially it sort of comes down to, you can have your best guess, but how are you ever going to predict something like a pandemic? You can't.
Yeah, and that's probably just one example, but economists and so-called experts have been around for many, many years, and they try to, whether it's clickbait or whether it's to make outlandish comments on certain things, which I don't like. I'm never a big one in terms of trying to make a scare tactic comment. I'm one in sort of summarising where we're at, and then giving a case as to what may be a best case scenario, what may be a worst case scenario, or trying to more so keep even keeled about investments. Because investing, if you're actually investing, which we talk medium to long term is investing, you shouldn't really know what the market's going to do in 6 to 12 months necessarily, because it's so volatile, it's so emotionally driven. But what you feel comfortable doing is that over the next 3, 5, 7, 10 years, you're going to be in a better position by maintaining an investment that you think has great fundamentals, which you alluded to before, as opposed to speculating, which sometimes I think economists and experts can borderline on the way of speculating and saying that this is going to happen, create a bit of panic and worry amongst people, but then it ends up not even being the case, and you never hear from that person again. That's the thing that frustrates me sometimes.
Yeah, absolutely. And it's more frustrating probably for you, because you would see the impact that some of these predictions would have on your clientele, right? Because sometimes people take this stuff as gospel, and it's like you need to take it with a grain of salt, tankers. Take it with a grain of salt. Any analyst, not just economic analysis, but there's a lot of analysts in the stock market too, Jolie, and I feel like you need to take their predictions with a grain of salt.
Yeah, absolutely, and they're out there to try to create clicks and headlines, and the market and investing is not a headline grabbing game. It's probably almost a boring game. You find something that's you think it's got good fundamentals and it's going to do well over time. It's got good management, or it's a good area for the property maybe, or a good commercial property with the right infrastructure around it. You're holding there for a long-term gain and an outcome over time. You're not checking it every day and checking the headlines every day, because that just causes panic and unnecessary angst. The news media does have a lot to do with creating nervousness in people, and that's why I think, sometimes keeping unemotional as an advisor for clients is one of the best things you can do, and they pay you to do, is so they don't make dumb decisions or irrational decisions off the back of what a so-called pundit may say in the media that day.
That's right. Well,
anyway,
that's good cover. Yeah, that's good coverage of why the stock market does not equal the economy,
if we do say so ourselves. So we'll shift into the money supply thing, Arndog, because I didn't really hit on QE before, because I felt that money supply thing. The question from Killer that came in was a good segue into a Q&A area. So the Q&A this week, Arnie, if you want to help us with this one from Killer, is I think the question was money supply, and how does that sort of factor in as an inflation bet? Is money supply considered a natural cause of inflation? Is that the question?
Yeah, it was, and he directly referenced it back to the Austrian school. So just for the tankers who aren't aware, there's a few different schools of economics. When Jolie and I were talking about inflation last week and this week, typically relying more on sort of the Keynesian school, which relies on sort of data and models. The way the Austrian school differentiates itself is it sort of uses like logic, for lack of a better word, to think through economic problems and come up with a solution. And
supposedly Keynes as well, for those that don't know, he's an Australian economist. He was Australian, wasn't he, Keynes?
I thought he was British, but
British,
God, I hope we can claim him. We'll have to look it up.
We'll have a look, But Keynes supposedly was a very, very good investor as well, which, contrary to what we were talking about with economists before, maybe not the best investors or predictors, but Keynes is actually a very smart guy and a very good investor. I believe his estate was worth, back in the day, multiple, $30-odd million. So, must have been a very smart guy. Well, he was with his, Keynesian theory, but, a good investor, I should say.
He's probably the most famous economist, and a lot of the economic policy you see around the world sort of stems from his ideas. But the Austrian school, not to be sneered at, because before I go into Killer's question about what about the definition of increasing the money supply being the cause of inflation, it kind of ties back to probably the most famous concept in the Austrian school, which is diminishing marginal utility. And what I mean by diminishing marginal utility is, if you can think about, me and Jolie decide we're going to go big gold prospectors, right? And Jolie and I have got a pan to pan for gold. And then I decide I'm going to try and come up with a better method, and I come up with a sluicing method of gold prospecting. But then Jolie notices and, sort of says, "Oh, a sluice. Can I borrow your sluice?" And I say, well, no, because, why would I give up my advantage here? So maybe I've got a few options at this point. I can either build a new sluice and give it to Jolie, or sell it to him, or rent it out to him. And then once we've both got a sluice, I go, oh, this is a good game. I've just sold Jolie this sluice for $1,000 or whatever it is. So I build another one and try and sell it to Jolie. He goes, well, why do I want to buy another sluice? I've already got one. Like, I'll give you $10 for it. So that's the diminishing marginal utility in a good, right? And that then flows onto another concept within the Austrian school, which is the diminishing marginal utility of dollars. So basically sort of saying, like, if, there's like heaps more dollars being printed and put into society, at what point is there too much money? And I think a really easy to understand example is, an extra dollar gets printed today, Jolie. It can either go to a billionaire or it can go to a pauper. Who's going to get more utility out of that extra dollar? Obviously, the billionaire will get like basically next to no utility out of one extra dollar, but the pauper will get amazing utility out of one extra dollar. So that's where the fundamentals of Killer's question come in. So then to go to Killer's question, do we think increasing the money supply causes inflation? The Austrian school would say that everything else being equal, if you increase the money supply, but you also increase, the goods and services being produced, then no, it wouldn't. But if you don't see a commensurate increase in all the other aspects, then you were probably going to cause inflation. And then they point to things like, this is just general in nature, so I'm just speculating here. This is not set in stone, but look at the housing prices in Australia or in America at the moment, going through the roof. But the prices of, the consumer goods we were talking about last week tend to be coming down. And that's been supported. If you go back and, I don't know if anyone's going to do this, but if you go back and look at like America's M2 money supply back in sort of between 2007, 2009, they were printing a lot of money, but the price of their consumer goods was dropping over that same period. So I feel like I can't give you a definitive answer, Killer, but the short answer is it's a mixture of both, like the Austrian observations and the Keynesian mathematics and data feeding in. So yeah, that's my long story.
Yeah, and Keynes was Cambridge, United Kingdom. So apologies for any UK listeners there. We tried to claim him quickly there, but I must have read something in year 11 economics, which I thought for some reason he lived in Australia or something. But yeah, Cambridge, England. He may have lived in Australia. Who knows? But I don't fact check that. I guess the money supply, it can be sort of considered an economic principle in terms of more supply lowers the scarcity of that dollar. So if there is printing occurring, which is what we spoke about with hyperinflation with Zimbabwe, where obviously the economy wasn't as big as a place like the US. They're printing and increasing this money supply. It lowers the scarcity of that dollar, which means that, again, giving the shopping analogy, if you had that dollar in your hand and it had been printed, so 2 to 1, then that those goods would potentially become more expensive. But as you also said, there's so many factors that go into making up an economy. The quantitative easing that's occurred hasn't seemed to have pushed inflation in a sense over in the US, and in Australia. Obviously, we didn't print money but purchased off the balance sheets and pushed JobKeeper out to businesses, which then helped businesses survive and then thrive at the end of it and get back to recruiting people and getting employment back up again. So yeah, it's a very, very full-on area and full-on subject to tackle. So we've tried to give a bit of a high-level view on it. We don't like to try to go too in-depth on this show, but we also like to give people some information. So always general in nature. So please don't take any of this as personal advice, and always seek personal guidance for your own situation. Next question, yeah. Arnie.
Yeah, the next question, I forget who asked us this question, but basically the question is...
Wasn't our mate from Africa, was it?
Maybe it was, or maybe it was our long-time listener, Carl with a K. But it was explained like on 5. I'm going to start writing people's names next to these questions. Explain like on 5, fully franked dividends, partially franked dividends, or franking credits. What are they, and why do businesses in Australia choose to do this?
Yeah, so franking credits are essentially the tax that the company pays on their earnings before they pay you the dividend. So, self-funded retirees that may not pay much tax because they're not working anymore, and potentially if they've got a fully franked dividend, and they might be able to claim 30% tax back on that. So if they got paid $100 of dividends, that's after franking, they might be able to claim another 30% or $30 back from the ATO because they're not paying tax in Australia because they're retired, and essentially that's their only income coming in. So that's sort of how franking credit works. And if you earn a larger income and your marginal tax rate's over 30%, then you don't really get to claim anything because you're paying tax anyway above a higher rate, but you just don't have to pay the full tax position because you got 30% franking. But then you pay tax on the additional of your dividends that you earn. And what was going to say? Why do they partially frank? So some companies, not standard, but an example could be that companies make a large portion of their income from non-taxable income. So it could be tax-exempt asset sales, real estate, investment trusts or REITs, or they may have sizable earnings in offshore operations. So in that case, it may not be optimal as a value add to attach franking credits, given those expenses are paid after tax by the company. So it just might not be in their best interest to have a fully franked dividend or claim a tax deduction on that. But the vast majorities do pay, of ETFs, for example, pay fully franked dividends to minimise the tax implications for their investors. And a lot of the big companies tend to do that. So the banks or your NABs, I think your Telstra is fully franked. So that's sort of an example of fully franked or partially franked. And the other big factor that influences why a company may partially frank a dividend is just basic corporate finance. So being what's optimal for the current rate, the current expected composition of a company's shareholders. So, who makes up the shareholder base? If the companies aren't concerned by their investors' franking credit needs or know the demand for their stocks are relevant from claiming a franking credit, because, maybe as a generalization, a lot of retirees might want to claim the franking credit, and that's the big reason they hold the stock. So if you were to disincentivize them for holding that stock, they may get out of it. So that's why a lot of companies will frank. But on the other side of the coin is companies may not feel their investor base really demands a franking credit, so they're happy not to worry about it, so they don't do it. So there's not necessarily one better than the other. It's just an outcome of how the franking system works, and hopefully that explains it in a little bit more detail for Carl with a K.
Can I say at a high level, just to try and summarize that in a nutshell, the reason, like from a policy point of view, that franked dividends, or that the franking system was put in place, I should say, was to eliminate the issue of double taxation. Jolly described it perfectly, but it just means basically companies already paid tax on those profits, and when they distribute it to the shareholders,
why do you need to pay more tax? Yeah,
exactly. And I can hit you with some more arithmetic if you want, Jolly. I've got the formula here.
Please don't, Arnie, but give us one quick one, mate. Give us one quick one.
Franking credit equals dividend amount divided by open bracket 1 minus the company's tax rate, close bracket, minus the dividend amount.
I love your algebra equations, Arnie. They thrill us every week, and I know our listeners are getting excited by that. And what was I going to say? And that's the reason I think political suicide, someone mentioned the other week, is when politics start talking about removing or scrapping franking credits, it does get people a bit up in arms, because it's like, well, we're not paying the tax because we're not taxpayers anymore, so why do we not get to claim it back? Why do we give that off? So that's it's an interesting one, but that's sort of the end of the Q&As for the week. So hopefully that helps cover off a few more areas and a few things of interest on people's minds and our listeners' minds. So let's move on to the next section, Arndog, which is the
50-50.
50-50, or what's your choice, or what's
either
the other
or.
one? Either or.
Either
yeah.
or.
So I've got a couple this week, Arnie. Do you want me to give two off this week? And again, our listeners, keep bringing them in. We love when we hear from the listeners. But happy for two this week, Arnie.
Yeah. Two for the price of one, always.
They're both food related, of course. So I texted you this one the other day. So full disclosure, Arnie knows one of them. He doesn't know the second one. So I texted you this thinking, this is a weird thing. I've never really heard of it before. But jam and cream on scones. There was like a question as to what's the way you have it, cream underneath, jam on top, or the other way around. And I've only ever known jam underneath, cream on top. But Arnie, yourself?
Mate, I've only ever known scone, then jam, then cream on top. And when you texted me the photo, we didn't discuss it because I thought better to leave it for the pod. But what a weird thing to put cream first and then jam on top. Like, how would that even spread properly?
It's a strange one because, the cream is soft, so the jam going on top is a harder condiment, so that's going to push the cream all around and potentially, wreck the setup you've got going on.
Just I have to choose, so I'm going to choose the traditional way, which is scone, then jam, then cream.
Bit of butter as well?
Oh, absolutely. Yeah, why not? Load it up. But I feel like the other way is so weird, man. I want to know from the tankers, has anyone ever tried it even? Or like, is it better? I don't know. Maybe I need to try it now.
Fill us in, yes, and let us know, tankers. Let us know if that's something that's just odd or if there's actually a percentage of the population out there that does it. Second question, Arnie, which I won't pre-answer myself, I'll throw to you. The old age question and the Australian delicacy of a sausage or a snag on bread. Do you have the sausage by itself, or if there is onions available, will you have sausage and onions?
I'll always choose onions. And I feel like unless you're allergic to onions, you're mad for not getting onions on your sausage and bread. And also, give me mustard and give me tomato sauce. What about you, Jolly?
On both, but at the same time, so both TS and mustard on the same time?
Absolutely.
Yeah, good. And onions on top or onions underneath?
I don't think it matters to me. Like, I think it's
the
stupid
thing. That was the Bunnings. I don't know if that was hype. I found out this week that people post things online to be antagonists in terms of actually trying to get like news media outlets. I think the Chaser did it this week to try to get news media outlets to jump on something without researching. So I don't actually know if there was
that real or not real?
If there was someone out there that actually said, someone got burnt with the sausages falling off their sausage and bread, so they complained and tried to sue Bunnings for it. So I don't know, but I haven't actually been for a Bunnings sausage for a while to see if they do onions underneath. But onions on top for me, onions every day of the week. Unless you're allergic, I don't want to hear your excuses for not having onions on your sausage.
I love that we agree on this, and I got to say, just it is onions underneath, Jolly, because I actually cooked a sausage sizzle yesterday at Bunnings for Charlie's Kinder.
Oh no!
Yeah, I was cooking yesterday, so they put the onions underneath.
They OH&S'd you. Oh, dude.
I was on the Barbie, but I saw some of the ladies who were volunteering. They were onions underneath.
Oh God, that's so strange. So yeah, onions on top. I demand onions on top. And a heap of them too. And yeah, unless you're allergic, I don't want to hear your excuses for not having onions. And yeah, I don't mind tomato and mustard, Arnie. I don't mind them in the same one. And I'll generally go for 2 sausages if I can, 1 for each hand.
That's 2 for 2, you and me agreeing this week, which is unusual, but I love it.
Very unusual. So yeah, let's hear from the listeners, and we want to hear your thoughts on the age-old debate. So I think that sort of tidies us up for this week, Arnie. We will enjoy our day today of hopefully the Melbourne Demons getting up against Hawthorn, making us 5-0. Be amazing, leading into a big Anzac Eve clash next week. So have to tie in our Melbourne Demons talk for all our listeners out there.
I'm pumped as, and tankers, that's money in the tank for another week. We appreciate it, and I don't know if it's going to be
jump onto our socials, and get onto YouTube or leave comments, emails, Facebook message. They're all great ways to get in touch, and we appreciate all your reviews. And if you can, give us some reviews on any of the mediums you listen to, whether it be Spotify or Apple, that'd be amazing.
Yeah, it is. It's at Money in the Tank in all of them. And Jolie mentioned a couple of weeks ago that he appeared on the Lone Room's Instagram Live, and I don't know if this is going to be next week, but in the near future we're going to try and get Marty, is it, from the Lone Room, Jolie, and we're going to try and get him on to have a chat with us and benefit the tankers as well. So stay tuned for that.
Tune in for that one, guys. So aim to do that next week. We're going to try and get Marty from the Lone Room on to talk money, finance, loans, all those things, whether it be first loans, investment loans, equity. So we're going to try to get more and more guests in to talk about certain areas and SMEs and certain topics. So I think that's sort of what the podcast demands, and I think it'll be great to hear different voices in rather than myself and Arnie waffling on.
Love it. Thanks, tankers. See you next week.
Look forward to seeing you next week. Cheers, guys.
Bye.